G'day Year 12 and welcome to another YouTube lesson. Today we're going to be taking a look again at finance and financial management, and we're looking today at the final part of processes. Remember we chatted before that there's 4 parts to each of the key business functions, in which there's 4 business functions. The only difference to that is HR that's got that final bit, the effectiveness criteria. So we're looking at finance and we're looking at processes. The set of steps, the things that a financial manager will go through in their day-to-day job. Now, as part of the process of financial management, we're looking at 3 dot points today from the syllabus. One is financial ratios, following on a bit from last lesson, but this notion of comparative ratio analysis. Sounds fancy, but you're just basically comparing the same ratio, like net profit ratio, but over different time periods or between different businesses. We're also going to take a look at the limitations of financial reports, the problems that we see with our financial reports and financial statements. And we're also going to be looking at ethical issues related to financial reports. And coming out of that Royal Commission in 2018 and the banks, there's some major ethical issues that we've seen in the financial industry and in terms of financial reports. So it's something good to mention in terms of your case studies. Now, the first bit here, under financial ratios, we have this comparative ratio analysis. It involves a business comparing, which is looking at its ratios, i.e., it can look at its net profit ratio or its gross profit ratio, not even profitability, it can be its debt to equity ratio, and seeing how it's gone against itself over a number of years, i.e., is it getting better? Or seeing how it's going in relation to the industry average, industry standard or other benchmarks, their competitor. And finally, seeing how it's going against, as I said, the similar businesses. So how's Woolies going against Coles in terms of net profit ratio or in terms of their debt to equity ratio or their current ratio and so on. Now, in relation to the industry standards, the business should generally have for each of these ratios, for the liquidity current ratio, a preferred ratio of 2 to 1, which means that for every $2 of current assets, there's $1 of current liabilities. Now, in terms of solvency, that's the debt to equity ratio and how we can compare the different ratios of different businesses based on the solvency, and the general preferred ratio of 60% for small business and 100% for large business. That means that for if we're talking about 60% for small, for every $6 of liability, there's $1 of total equity. And we're talking about 100% for large businesses, it's $1, right? $1 of liabilities for $1 of equity. Another way to be able to compare the different ratios of business is using the return on equity ratio, or the ROOE, return on owner's equity ratio. The general preferred ratio is about 20% for that. That means that for every $1 of equity, there is 20 cents made in net profit. And you would look at how the return on owner's equity has been for your business this year compared to last year. That's comparative ratio analysis, or from this year compared to a couple of years ago. Or you could be having a look at how it's against this preferred ratio, or more against the industry average. Time and time again, I tend to see mainly 2 main comparative ratio analysis. Firstly, they're comparing whatever ratio you're using with business A, okay, against itself but the previous year or the previous few years. The other way I tend to see comparative ratio analysis always, or generally, is a specific business, and it will have in the notes the industry average, which is that industry standard, and you've got to comment on whether business A is doing better or worse than the industry average, and maybe why. Now, there's also the accounts receivable turnover ratio, and the general preferred ratio is 14 to 30 days that you would expect to have it. This means that clients on average pay their bills between 14 and 30 days. Any longer than that, you could say that this particular business, when using comparative ratio analysis, is worse than the average. All right. Now, ways that we can measure them, as I'd mentioned briefly above or before, I'm not looking at notes or anything, is through over different time periods from the syllabus. You can compare one business against itself over a number of years. All right, now this is one of the most useful strategies, I think, of comparative ratio analysis, because if you said, look, the net profit ratio is 20%, which means for every dollar of sales, there's 20 cents in net profit. Is that good? I don't know. That's why we use comparative ratio analysis. It's good if it used to be 5% 3 years ago, and then it was 7, and then 15, and now it's 20. That trend, the pattern, the trend is getting better. Hence, this is why comparative ratio analysis is so important. Another way to measure a business using comparative ratio analysis is against standards. Okay, and we're talking about industry average. That's the term we see in the HSC all the time, the industry average. All right, so you can also compare it against, I guess, world best practice. Benchmarking is a term you'll hear with this stuff, which is to try and reach a particular level, net profit ratio at this level or whatever it may well be, and you set that as a standard. It's called benchmarking. And often you'll benchmark your business against the best in the industry, which is world's best practice. Like my teaching, it's often benchmarked against me, understandable or not, and also against that industry average. The final way that we use comparative ratio analysis is with similar businesses. So you might sometimes have business A and business B, Coles and Woolies for argument's sake, and you look at Coles's net profit ratio compared to Woolies' net profit ratio. Whose is better? It's a good way to use this comparative ratio analysis. All right, now that's the first of the 3 syllabus dot points we're looking at today. The next one is limitation of financial reports. It's the next step here, the second last one in the process of financial management. All right, now limitation of financial reports includes things such as balance sheets. All these financial statements are balance sheets, cash flow statements, income statements. They're generally pretty useful and reliable and of merit. However, there's 5 key instances where they can have limitations or become unreliable. Limitations are because of these 5 things. Firstly, normalizing expenses. Secondly, we've got capitalizing expenses. Thirdly, issues with valuing assets. Fourth, timing issues. And the last one is because of debt repayment issues. So we're going to look at what these mean and how you can sort of find them on your various financial statements. The first one, before we go further with it, a lot of these are quite difficult for kids to comprehend and get. If you understand it as we're going through, be proud of yourself, you're doing well. If you don't get it, don't stress. Look at the video again, come and see me, ask me on Slack. This is one of the harder parts of the course. Normalized earnings are earnings that have been adjusted, changed, altered to remove one-off or unusual items that affect profitability. This is done to give a more accurate depiction of the true earnings of a company. So it might be done for the right reasons. This makes it easier to compare profitability figures for a business from one year to the next and also against other businesses. I'll give you an example. An example is a removal of land sale, which would achieve a large capital gain. So if we had business X sells this land for $1 million, $1 million in 2018, then it can make its income look inflated for that particular financial year. They're not selling $1 million worth of land, because they don't have that every year, and therefore it doesn't look so realistic. All right? They do this to give a better trend of the actual business performance, but it's a limitation because it's false. It's not a true reflection of that financial year. So I guess in some ways, done in the right way, it's being more, not about honest, but it's making it look more realistic with what usually happens. It's not this big spike in the sale of the land in terms of the income that comes in. But is it a true reflection? The answer is no. So therefore, we see it as a limitation, an inaccuracy with the financial reporting. The next one is capitalizing expenses. This refers to claiming certain expenses as additional assets. This is done to claim the tax benefit of depreciation. An example of this would be claiming the legal fees and stamp duty when purchasing a new factory as an additional asset, not as a usual expense. Now, this distorts the assets and the liabilities of a business. So what we're talking about here is that you've got, a land, a factory you've bought, and it might cost $1 million. On your balance sheet, you would see it in the non-current assets as $1 million. But did it really cost you $1 million to actually acquire that factory, that shop front, whatever it may well be? Not really. There's legal fees, stamp duties, as we said. These are additional expenses to buy it. Like my house, when I first bought it back in the day, years ago, was $520,000 is what I paid. But I had to pay, mortgage insurance, stamp duty, conveyancing, which are legal fees. All of that probably totaled to another sort of $40,000. So on my balance sheet, my house is not $520. It's more like the extra 40, $560,000. I'm allowed to have it as being valued at $560,000, not the real $520 I paid for it. Now, this distorts the assets and liabilities of a business, okay? But I guess in a way, again, done in the right way, it's showing how much you had to pay for that property, that asset. But if you were to resell that, then you're not going to be getting that amount of money back. I'd only get the $520, given that we're assuming my house didn't go up or down in value. Sydney's property market, bloody hell, hate to think what it'll be all worth in 10 years' time. Now, valuing assets is the next limitation of financial report. On the balance sheet, assets are valued at the original cost they were paid for. Yeah, sweet as. E.g., land for a factory might have been bought for $200,000. However, 15 years later, it may well have probably doubled, if not more, in value. $400,000, $500,000. As a result, the balance sheet is not an accurate reflection of the business's actual asset value. So you look at your balance sheet on the left-hand side, and that's left for me. It might be left for you over there. Don't know how the cameras work. Okay, but I have it as $200,000. That's what I paid for it. Okay, the historical cost. But if I got it revalued, it would be more $500,000. So that's undervaluing my assets, I guess, because of inflation and the fact that property and assets like that, certain assets, but land and buildings, go up generally over time. All right, you can get them revalued. It's expensive and it doesn't happen all that often. So if it hasn't been redone, revalued, then it's an inaccuracy and therefore a limitation, a problem of financial reporting. All right, getting there. Timing issues is the next limitation that you need to talk about in an extended response. This refers to a business holding off on paying their accounts receivable, their debts, until the end of the financial year, in order to make the business look more profitable. And I mean, not even the end of this financial year, they hold off until the next financial year. So if you think about it, you've got your financial year ending in the middle of the year. You can make this big payment of whatever it may well be. It might not be accounts receivable. It can be any debt you've got. You can make that final payment inside that year. Okay, but then it makes the profitability look bad for that year. Or you'll be a bit dodgy, perhaps, and just say, look, mate, hey, can you just wait a week or two? We'll make that payment then. A week or two later, it's not in that current financial year, it's in the future one. So that year looks crap house, but the current one looks better. Now, sometimes it's done just incidentally, okay, because, it just depends when people go and send you their invoices, but sometimes it's done on purpose. Now, the reverse can occur as well, where we might get somebody to throw all their debts into one financial year at the end so that the following year looks great. And look how good I am as a manager. I'm improving things. Again, this can skew, your income statement, okay, and your other financial statements, and it can make them look better or worse than what they realistically are. A limitation of financial reporting. All right, getting there. The next one we've got here is debt repayments. There are many debts that a business has that may not be declared officially on the balance sheet or declared and potentially should not, therefore a limitation. Some examples include the employees of a business may have a number of years long service leave saved up or holiday pay. Okay, and as such, if staff take all of their leave altogether or lots of them in a short period of time, which can happen sometimes, then And this is huge cost to the business. I'll give you an example. I've now been teaching for, looking at my age, probably 2 or 3 years. But no, I know it's a shock with this handsome look. I've been teaching for, better part of about 15 years. So, in terms of long service leave, I've got about 15 weeks saved up. If you're not nice to me, I'll take it all at once, then I won't be there for a term and a half. Okay, so that 15 weeks, imagine if quite a few teachers did that. The school would have to employ lots of casual teachers or temp teachers, additional expenses. And so that's not always recorded in great detail, and that could be a cost. Another example is the workers at Qantas. They've built up lots of frequent flyer points. If they collectively, lots of them at a point in time, used their frequent flyer points, it would add an additional cost to the business. All right, there's other examples that you can look at in the notes that we've got and other examples from the textbooks. So these are all problems, limitations of financial reports. But wait, sir, you might ask, you're missing one. Notes to financial statements, that's also a limitation of financial reporting. Not really. It comes under the heading, but it's the opposite of the limitation. So at the bottom of most financial statements, balance sheets and income statements, there's a number of notes that provide more detail to the financial report. Might say something like industry average, or often it's got, some detailed reports, hundreds of little notes, little things, things that you need to look at. This is included to make the financial report more accurate. As I said before, note it's not a limitation to a financial report, but it's something useful because it provides additional detail. It may well say, note, in terms of, the valuing the assets of this factory, it was valued in 1980. These days it would be more like blah, blah, blah. So it gives a more realistic version, kind of like the strategy to fix these limitations. All right, we're almost there. It was a big one today. We're looking at now ethical issues related to financial reports. And this is the last part of the processes. You're doing well. It's the first topic we do. And we've already done 3/4 of it, just the strategies to go. Some of the ethical issues are business need to take a more ethical approach to their accounting methods when creating their various financial reports and not use this notion of creative accounting. This is mainly because society expects it these days, and if businesses don't do this, they will face big public backlash, and therefore it's a huge societal influence. It's very important to a business these days. We need to make sure that businesses aren't using creative accounting, which is, taking advantage of these limitations. So I mentioned it's okay to do some of these things if they're, like the things we mentioned before, such as timing issues, valuing assets, capitalizing expenses. They're all okay if it's not done to trick the shareholders, and to make people think a business is more profitable than what it is. All right, then it's okay. But creative accounting is when you do it on purpose, and that can be unethical, but when it's overtly, like really badly done and on purpose, okay, then it can verge on legal action, and people can go to prison, and hopefully some people will have gone to prison and been prosecuted over the Financial Royal Commission, because there were some pretty corrupt people from some of those big 4 banks. All right, now they also need to conduct both internal and external audits. So this is what audits are. They're getting another person or organisation or department to review, audit the financial statements of a business. Generally, you've got any decent business will have people come in from inside the business in their roles to conduct internal audits to check that things are all okay, there's no issues. All right, but sometimes you'll ask external people from KPMG, a business that might come and do it. You might pay them, or even the ATO. That's not such a good thing. They might come and do an external audit. All right, the other major way to act in an ethical way is to focus on the thing called the triple bottom line, which is 3 things. The bottom line is the coin, the money, the finance, making a profit. You want it to be in the black, not the red. But we've now got 2 other focuses with the triple bottom line. It's a focus on society and also a focus on the environment and environmental sustainability, not just on profit. That's why it's triple bottom line. Also sometimes known as this corporate social responsibility. All right, guys, thanks, and see you later.